There is a reason many people feel that money disappears faster than it should. It is not only because they are irresponsible, it is not only because they buy too many things. It is not only because they lack discipline. The deeper reason is that time is working against their paycheck, and once you understand that, you can begin making time work for your investments instead. That is the central idea. A paycheck is usually linear. You work a week, you get paid, you spend, you save what is left. If anything is left, then the process repeats. But expenses do not always move in a neat linear way. Inflation can move faster than wages. Interest rates can rise, food can cost more, debt can become heavier, housing can become less affordable. The same income that once felt adequate can suddenly feel weak, not because the number went down, but because the purchasing power behind the number fell. That is what many households have been living through. Their paycheck still arrives, but it buys less, and that creates a feeling of pressure that is very real. The mistake many people make is that they respond to that pressure by waiting. They wait until they have more money to invest. They wait until the economy feels better. They wait until the market looks safer. They wait until inflation calms down. They wait until the headlines make them feel comfortable. But the problem with waiting is that time continues moving. If time is eroding the value of your paycheck, then doing nothing is not neutral. Doing nothing lets the pressure continue. The solution does not have to begin with a large amount of money. That is where most people misunderstand the process. They think wealth begins with a large deposit. But in many cases, wealth begins with a small habit that survives long enough for compounding to become visible. $35 a week does not sound powerful. $5 a day does not sound like the beginning of $1 million portfolio, but small amounts can become serious capital if they are invested consistently, reinvested, and left alone for enough time. That is not because the amount is large, it is because the system is consistent. Time punishes idle cash when inflation is high. But time rewards invested capital when the assets grow and the dividends are reinvested. This is the shift. You move from being on the wrong side of time to being on the right side of time. Now, before we talk about the Fidelity funds and the long-term projection, we need to understand the pressure that makes this strategy necessary. Look at food prices. Food is not a luxury. It is one of the clearest ways ordinary people feel inflation. You can talk about CPI reports, indexes, and economic releases. But a household understands inflation when the same grocery cart costs more than it did a few years ago. Since 2020, food prices have climbed in a painful sequence, about 3.45%, then 3.94%, then a major jump of 9.95% in 2022, then 5.76% in 2023, then 2.26% in 2024, then around 2.45% in 2025. Those numbers may sound abstract until you translate them into real life. A $20 basket of groceries in 2020 costs about $25.32 in 2025. That is not a theoretical loss. That is a lived loss of purchasing power, and what makes it harder is that wages do not always keep pace with that accumulated increase. If wages grow around 3 to 4% in a recent year, that may sound acceptable in isolation, but it does not fully repair the damage caused by years of rising prices. This is how people fall behind. Their paycheck may grow slightly, but the cost of living grows faster over the whole period. The number on the paycheck increases, the life the paycheck can buy may still shrink. That is the difference between nominal income and real income. Most people focus on nominal income. The economy punishes them through real purchasing power. Now add interest rates. Borrowing money has become more expensive. Rates moved from near zero in 2020 to around 4% by late 2025 in the source data. That change affects mortgages, car loans, credit cards, business borrowing, and many other forms of debt. A higher interest rate world is a heavier world for borrowers. The monthly payment rises, the required income rises, the margin of safety shrinks. When food, housing, transportation, and borrowing costs rise, the average person feels squeezed from multiple directions. This is why weekly investing feels difficult. Not because the concept is hard, because people are under pressure. When your environment becomes more expensive faster than your paycheck grows, even a small weekly investment can feel like a sacrifice. But that is exactly why the habit matters. In a world that keeps taking small amounts from you through inflation, interest, and rising costs, you need a system that quietly sends small amounts in the other direction. Money toward ownership, money toward assets, money toward compounding, money toward a future income stream. That is the purpose of weekly investing. It is not impressive at first. It is not dramatic. It does not make you feel rich next week. But it reverses the direction of the system. Instead of every week being only a cycle of earning and spending, every week becomes a small act of ownership. That is how the machine starts. Now, some people say they want to wait because markets are volatile. That sounds rational, but history shows something important. The stock market has had crashes. The Great Depression, the dot-com crash, the financial crisis, the COVID crash, the inflation-driven decline in 2022, each one felt terrifying in real time. Every crash produces reasons to stop investing. Every crash produces headlines that make people believe this time is different. Every crash feels obvious only after the recovery has already begun, but long-term market history shows that major crashes have eventually recovered and the long-term trend has continued upward. This does not mean markets are safe every day. They are not. It does not mean every fund or company will recover. They will not. It does not mean you can ignore risk. You cannot. But it does mean that trying to perfectly time the market is often much harder than consistently participating in it. Weekly investing solves a problem that most investors cannot solve with prediction. If the market goes up, you participate. If the market goes down, you buy more shares at lower prices. If the market is volatile, the habit continues. If inflation is painful, the investment still moves into productive assets. This is why weekly investing can be more practical than one-time deposits for many people. A large one-time deposit creates emotional pressure. Did I buy too high? Should I wait? What if the market drops tomorrow? Weekly investing turns the question into a process. Did I invest this week? That is the controllable variable. A good system converts emotional decisions into repeatable actions. That is one of the most important principles in personal finance. Now, the source makes a powerful comparison. If the average paycheck grows around 3 to 4% per year, and a long-term portfolio grows at something closer to 10 to 11% per year, including dividends, then over time the portfolio begins to do something the paycheck cannot do. It begins compounding faster than labor income. This is the entire point. Your paycheck is tied to your time, your job, your employer, your bargaining power, your skills, and the labor market. Your portfolio is tied to ownership. Ownership can scale in a way labor often cannot. If you work 1 hour, you get paid for 1 hour. If your capital owns pieces of thousands of companies, those companies can produce earnings, reinvest, raise dividends, expand, and compound while you sleep. That does not happen immediately. It happens after years of consistency, but when it happens, it can become larger than many full-time jobs. That is how a small weekly habit can eventually aim towards something like $8,000 a month in portfolio income. Not because $35 is large, because $35 repeated long enough can become a large base, and that base can eventually produce income. Now let us look at the snowball effect. Suppose someone invests $20 per week, that is $1,040 per year. For many people, $20 feels too small to matter. That is a mental error. Small amounts do not matter much in the first week. They matter because they are repeated, invested, and compounded. In year one, the contribution is only $1,040. With normal market growth and reinvested dividends, the balance starts to move slightly. It is not dramatic. It does not feel like wealth, but the base of the snowball is forming. By year three, total contributions are $3,120, with reinvested dividends and the early deposits having time to grow. The balance may be around $3,750. That additional amount did not come from more labor. It came from the beginning of compounding. By year 5, total contributions are $5,200. The account may be closer to $6,850. Now the snowball has real weight. Every new weekly deposit lands on a larger base. Every dividend buys more shares. Those shares can create more dividends. Every market recovery works on a larger amount. That is how the compounding loop strengthens. But here is the problem. The first 5 years do not look explosive. They look slow. And most people judge the system too early. They put in a little money, watch the balance move slowly, and conclude that the strategy is not working. That is like planting a tree and getting angry that it does not produce shade in the first week. The early years are not designed to impress you. They are designed to build the base. If you quit because the early years look small, you never reach the period where the numbers become meaningful. This is why mindset is as important as the math. Most people do not fail at weekly investing because they cannot understand it. They fail because they cannot emotionally respect small beginnings. They are wired to want fast results. They expect a linear reward for a linear contribution. But compounding is not linear. Compounding builds in curves. At first, the curve is almost flat. Then it bends. Then it accelerates. The investor's job is to keep contributing while the curve still looks flat. That is the hard part. If you can do that, you give the curve time to bend. The better question is not, is my portfolio growing fast enough this week? The better question is, did I invest this week? That question changes everything. It moves the focus from outcome to process. You cannot control what the market does this week. You can control whether you invest. You cannot control whether inflation prints higher or lower. You can control whether your weekly contribution happens. You cannot control whether the headlines are frightening. You can control whether the system continues. That is the mindset shift. Consistency becomes the measure of success, not short-term performance. Now, once that mindset is in place, choosing the right investments becomes much easier. You stop searching for the perfect stock tip. You stop believing that one magical pick will solve everything. You begin looking for structural characteristics, diversification, broad exposure, real historical performance, dividend growth, low fees. These are not exciting words, but they are the foundation of a long-term portfolio. Diversification means you own many companies instead of betting your future on a few. If one company fails, it does not destroy the entire plan. If one sector struggles, another may do better. If one business model declines, others may rise. A diversified portfolio is not designed to make you feel like a genius in 1 year. It is designed to keep you in the game for decades. Broad exposure is related, but not identical. Diversification is about the number of holdings. Exposure is about the kinds of businesses you own. Large companies, mid-sized companies, small companies, growth companies, dividend companies, sustainable companies, different sectors, different styles. Markets rotate, some years large cap technology leads, some years mid-cap companies do better, some years dividend and income strategies help, some years growth dominates. A long-term portfolio should not depend entirely on one style leading forever. That is why exposure matters. Then there is historical performance. This does not mean the past guarantees the future. It does not. But you do want investments backed by real businesses, real earnings, real dividends, and real records of performance. Not only hype. Hype can create big short-term moves, but retirement wealth is built through assets that can survive decades. Dividend growth is another key ingredient. A dividend is not only a cash payment. When reinvested, it becomes more ownership. If the companies inside a fund raise dividends over time, the compounding loop can strengthen. Dividend growth means the income stream may grow, and that growing income can buy more shares, which can produce more income. That is a powerful mechanism. Finally, fees matter. Small fees look harmless over 1 year, over decades. They are not harmless. A high expense ratio removes money from the compounding machine every year. A low fee or zero fee fund leaves more of the return working for you. The difference can become very large over long periods. This is why the Fidelity funds in the source are attractive. As a simple example, they are not presented as magic. They are presented as a group of funds that can work together because they cover different parts of the market, provide diversification, include income and growth elements, and keep fees controlled. Now let us look at the 5 funds. The first is FROX, the Fidelity Zero Total Market Index Fund. This is the core. A total market fund gives exposure to large, mid, and small U.S. companies across major sectors. Instead of trying to select one winner, you own the broad U.S. market. The purpose is simple: own the whole machine. If one company rises and another falls, you are not dependent on one outcome. If one sector leads, you participate. If leadership changes, the portfolio still has broad exposure. FROX also has zero management fees, which is powerful because every dollar not paid in fees remains available for compounding. The source gives FROX a yield of about 1.04%, dividend growth around 7.55% per year, and annual price appreciation around 13.5%. The numbers may change over time, but the role is clear. This fund lays the foundation. The second fund is FSMDX, the Fidelity Mid-Cap Index Fund. This fund focuses on mid-sized companies. Mid-cap companies sit in an interesting part of the market. They are often more established than small companies, but they may still have more room to grow than the largest companies. This can create a useful balance. You get exposure to companies that are not necessarily the mega-cap giants, but may still be in expansion phases. The source describes FSMDX as holding around 300 companies across technology, industrials, consumer sectors, and finance. It has a yield around 2.42%, dividend growth around 17.21%, and annual appreciation around 7.4%. Its role is to add the expansion phase of the market. Not only the giants, not only the most established names, companies still climbing. The third fund is FITLEX, the Fidelity U.S. Sustainability Index Fund. This fund brings a more modern tilt. It focuses on companies screened for stronger environmental, social, and governance characteristics, with exposure to areas like technology, healthcare, and communications. Whether an investor cares about ESG as a values framework or simply as a style of exposure, the investment question remains the same. What role does the fund play in this portfolio? Fidelity adds exposure to companies that have shown strong momentum in sectors associated with long-term change and resilience. The source gives Fidelity a yield around 1.14%, dividend growth around 13.74%, and annual appreciation around 13.06%. Its role is growth with a modern quality tilt. The fourth fund is FGRX, the Fidelity Growth and Income Portfolio. This fund brings balance. It invests mostly in high-quality, large-cap companies with stable earnings. It blends reliable dividend payers with consistent growers. That combination matters because a portfolio built only for growth can become volatile, and a portfolio built only for income can become too slow. Growth and income together can create a more balanced compounding engine. The source gives FGRX a yield around 3.13%, dividend growth around 19.68%, and annual appreciation around 8.17%. That mix supports both income and growth. It is designed to lift both sides of the portfolio. The fifth fund is FDGFX, the Fidelity Dividend Growth Fund. This is the income stabilizer. It focuses on companies with long histories of raising dividends and strong financial fundamentals. It leans toward consistency rather than aggressive growth. That role is important when markets cool off, when growth stocks are under pressure, when investors become defensive. Dividend growth exposure can help provide discipline and income stability. The source gives FDGFX a yield around 3.2%, dividend growth around 18.03%, and annual appreciation around 2.78%. Its role is not to race. Its role is to strengthen the dividend compounding loop together. The five funds create a simple, equal-weighted portfolio in the source example. FraxRox gives broad market exposure, FSMDX gives mid-cap expansion, Fidelity gives sustainability and modern growth exposure, FGRX gives growth and income balance, FDGFX gives dividend growth stability. This is not the only possible portfolio. It is a framework. A strong portfolio should not depend on one fund doing everything. It should combine roles: core growth, expansion, modern growth, income balance, dividend stability. Now let us calculate the portfolio's average yield the way the source does. The yields are listed as follows: FODSROX at 1.04%, FSMDX at 2.42%, Fidelity at 1.14%, FGRX at 3.13%, FDGFX at 3.2%. Add those together: 1.04 plus 2.42 plus 1.14 plus 3.13 plus 3.2 equals 10.93. Because the example treats each fund as an equal part of the portfolio, divide 10.93 by 5. That gives 2.186 rounded to 2.19%. So the portfolio has an average dividend yield of about 2.19% under this simple equal-weighted calculation. Now use the same process for dividend growth and annual appreciation. Add the dividend growth numbers, divide by 5. The result is an average dividend growth rate around 15.24%. Add the annual appreciation numbers, divide by 5. The result is average annual share price appreciation around 8.98%. Again, these are based on the source's simplified assumptions and historical figures. They are not guaranteed future results, but they show the structure of the portfolio. It has some current yield. It has strong dividend growth. It has long-term appreciation. That combination is the engine of the projection. Now let us look at the example of Josh. Josh invests $5 per Dalton Y. That is $35 per week since the portfolio has 5 funds. This is like putting about $1 per Dalton Y into each fund. That is small. Most people spend $5 a day without thinking: a coffee, a snack, a small convenience purchase, a subscription cost divided across days. But the issue is not whether $5 feels large today. The issue is what $5 a day becomes when it is repeated for decades and invested into a portfolio that grows, pays dividends, and reinvests those dividends. By the end of year 1, Josh contributes around $1,825. That is the foundation. It does not make him rich. It proves the system is working. By year 10, the portfolio is projected to reach around $32,000. Now the base is meaningful. Reinvested dividends are starting to matter. Market growth is working on a larger amount. The habit has survived long enough to become visible. By year 20, Josh has contributed around $36,500 total. But the portfolio is projected to reach around $160,000. Now the difference between contribution and compounding becomes obvious. The money he put in matters, but the growth above his contributions is becoming much larger. The portfolio may be generating around $9,000 per year in dividends by that point under the source assumptions. That is real income. Not enough for many people to retire on, but enough to prove that the machine has become meaningful. Then the final decade shows the real power of compounding. By year 30, Josh has contributed a total of $54,750 out of pocket. That is the amount he personally put into the system, but the portfolio is projected to reach about $942,000. That means the portfolio multiplied his contributions more than 17 times. The difference between $942,000 and $54,750 is about $887,250. That difference came from compounding, reinvested dividends, and long-term market growth under the assumptions. This is the point. Most of the future wealth did not come from what Josh paid in. It came from what the portfolio did after the habit was established. That is the power of time. And under the source projection, that portfolio could produce around $98,000 per year in dividends. That is about $8,000 per month. That is more income than many full-time jobs from $5 a day. Now, that projection should be understood carefully. It depends on returns, dividend growth, reinvestment time, and the assumptions staying favorable. It is not a guarantee. Markets can underperform, dividends can change, funds can change, inflation can change the real value of that income, taxes can matter, investor behavior can break the plan, but the lesson is still powerful. The amount does not have to be large if the habit is consistent and the time horizon is long. The real danger is not that $35 a week is too small. The real danger is that people stop because it looks too small. That is the psychological trap. The portfolio only has a chance to become large if the person keeps contributing through the boring years. The first year is not exciting. The 5th year may still feel modest. The 10th year begins to look real. The 20th year shows the machine. The 30th year can change the whole financial life. That is how compounding works. Most of the magic is late, therefore the early discipline is essential. Now let us talk about why weekly investing can work better than trying to make one perfect deposit. A weekly system reduces timing risk. If you invest everything at once, you may worry that the market will fall immediately afterward. If you invest weekly, you spread the purchases across time. When prices are high, you buy fewer shares. When prices are low, you buy more shares. This does not guarantee a better outcome than lump sum investing in every environment. Historically, lump sum investing can often win when markets trend upward, but weekly investing can be psychologically easier and more durable for ordinary people, and durability matters. The best strategy is the one you can actually follow. A mathematically optimal plan that causes you to panic and quit is not optimal in real life. A simple weekly plan that you stick with for 30 years can be far more powerful. That is another principle. Behavioral sustainability is part of return. If a strategy fits human behavior, it has a better chance of survival. Now, the source's message is not that Fidelity is the only way. The deeper message is that low-cost diversified index-based investing can turn small habits into large future assets. Fidelity funds are one example because the platform offers broad market access, zero-fee funds, index funds, and dividend-oriented funds. A similar principle can be applied elsewhere. What matters is the structure, low fees, broad diversification, consistent contributions, dividend reinvestment, long time horizon, no panic selling, no market timing obsession. That is the system. If you remove any one of those parts, the result changes. High fees reduce compounding. Lack of diversification increases the risk of failure. Inconsistent contributions weaken the base. Spending the dividends interrupts the snowball. Short time horizons limit the curve. Panic selling breaks the machine. Trying to time every dip creates paralysis. The system works only when the pieces work together. Now, there is another important insight. Weekly investing changes identity. A person who invests every week begins to see themselves differently. They are no longer only a worker and consumer. They are an owner. Every week they buy more ownership, more shares, more claims on future earnings, more exposure to dividends, more participation in productive enterprise. This identity shift is powerful. The worker asks, "How much did I earn this week?" The owner asks, "How much did I add to my system this week?" The worker lives only on labor income. The owner gradually builds capital income. The worker depends entirely on the next paycheck. The owner creates a second engine at first. The second engine is tiny, but over time, it can become larger than the first. That is the goal. Not to hate work, not to avoid responsibility, but to build a system where capital works beside labor. Eventually, capital can work even when labor slows down. That is financial freedom. Now, most people do not get there because they judge small beginnings incorrectly. They spend $5 without thinking, but they do not invest $5 because it feels insignificant. That is backward. A $5 convenience purchase disappears. A $5 investment becomes ownership. One is gone. The other enters a system. The difference over one day is small. The difference over 30 years can be enormous. That is why the small habit matters. Now, let us examine the income projection carefully. The portfolio's average starting yield is around 2.19%. That does not sound like much. If you have $10,000, a 2.19% yield is only about $219 per year. That will not change your life, but dividend growth changes the picture. If dividends grow over time and are reinvested, the number of shares rises and the payout per share can also rise. That creates a compounding effect within the income stream itself. The portfolio's average dividend growth rate in the source is around 15.24%. That is very high and may not persist forever. So it should be treated carefully, but it illustrates the power of growing income. A static yield is one thing, a growing dividend stream is another. If the companies inside the funds continue raising dividends, and those dividends buy more shares, the income base can grow much faster than the initial yield suggests. That is why dividend reinvestment matters. Spending the dividends early may feel nice, but reinvesting them gives the snowball more material. In the accumulation phase, reinvestment is usually powerful. Later in the income phase, the investor can choose to spend dividends if needed, but during the building years, reinvestment accelerates the process. Now we should also understand annual price appreciation. The source uses an average annual appreciation of about 8.98%. Combined with dividend, growth, and reinvestment assumptions, this supports the long-term projection. But again, markets will not move smoothly. A 30-year journey can include several crashes. There may be years where the portfolio falls 20% or more. There may be years where dividends grow slower. There may be years where one fund underperforms. The investor must not assume the path is smooth. Compounding is powerful, but the emotional path is volatile. This is why the mindset section is so important. If Josh invests $35 a week for 20 years and then panics during a crash, the plan can fail. If he stops contributions during every scary headline, the base grows slower. If he sells because the portfolio is down, he interrupts the machine. The system requires not only money, but behavior. Behavior is the hidden variable in every financial projection. A spreadsheet assumes consistency. A human has emotions. The investor must build systems that protect consistency from emotion. Automatic weekly contributions help. Dividend reinvestment helps. A long-term written plan helps. Understanding the history of crashes and recoveries helps. Keeping the amount small enough to sustain helps. Not checking the balance every hour helps. That is how you make the plan survivable. Now, some people may object that $35 a week is still hard. For some, it is. The point is not to shame anyone. The point is to show that the threshold is lower than many people think. If $35 is impossible right now, start with $10. If 10 is impossible, start with 5. The first purpose is not the amount, it is the habit. Then work on increasing income and reducing unnecessary expenses so the weekly amount can rise. The habit starts the machine. Income growth fuels the machine faster. If someone can eventually invest more than $35 per week, the results can be larger. But the $35 example is powerful because it makes the idea accessible. It shows that the path does not require being rich first. It requires consistency first. That is a very different mindset. Now let us connect this back to the inflation problem. Inflation is like a current pushing against you. If you keep all your money as cash while the cost of life rises, you are moving backward in purchasing power. If your wages rise slower than cumulative prices, you are moving backward. If debt becomes more expensive and you carry variable rate or high interest debt, you are moving backward. Investing is not guaranteed to solve every problem, but it gives you a chance to own assets that can grow faster than the cost of living over long periods. That is why ownership matters. A paycheck can be squeezed. Ownership can compound. The goal is to move part of your weekly income into ownership before inflation and consumption absorb it. If you wait until the end of the month, there may be nothing left. If you make investing automatic, you force the system to build ownership first. This is a principle. Pay yourself first is not a slogan. It is a defense against the economy pulling every dollar away from you. Now, the portfolio S5 fund structure also teaches another lesson. You do not need complexity to begin. Many people delay investing because they think they need to master everything. They want the perfect fund, the perfect entry, the perfect allocation, the perfect forecast. That search for perfection becomes a form of procrastination. The future belongs more to the person who begins a good plan than to the person who endlessly searches for the perfect plan. A simple diversified portfolio can be enough to start. It can be reviewed and improved over time. But the first step is getting money into the system. That is where weekly investing helps. Now, let us talk about fees again, because this is one of the few things investors can control. You cannot control market returns. You cannot control inflation. You cannot control the Federal Reserve. You cannot control whether next year is a recession. You cannot control whether one sector leads, but you can control what you pay. If two funds provide similar exposure and one charges much less, the low-fee fund leaves more of the return in your account over 1 year. The difference may seem small. Over 30 years, it can become large. Fees compound against you, returns compound for you. Keep fees low so more of the compounding works in your favor. That is why zero-fee and low-fee funds are attractive in long-term strategies. Now, diversification has another benefit. It reduces the need to know the future. If you own only one company, you need that company to succeed. If you own one sector, you need that sector to lead. If you own one style, you need that style to remain favored. But if you own broad market exposure, mid-cap exposure, sustainability exposure, growth and income exposure, and dividend growth exposure, you reduce dependence on one outcome. The portfolio is still mostly equity risk. It can still fall, but it is not tied to a single business or one narrow idea. That is important for a plan that may last 30 years. 30 years is a long time. The world will change, leadership will rotate, companies will rise and fall, inflation will change, rates will change, technology will change. A broad portfolio accepts that you do not know which company will dominate every future period. It owns the system instead. That is a rational approach for many ordinary investors. Now, I want to make a careful distinction. The source discusses dividend income reaching around $98,000 per year after 30 years under its assumptions. That does not mean you should ignore total return and only chase yield. High yield can be dangerous if it comes from weak companies, unsustainable payouts, or falling share prices. The funds in the source combine yield, dividend growth, and appreciation. That combination matters. A portfolio with a high starting yield but no growth may not keep up with inflation. A portfolio with strong price appreciation but no income may still build wealth, but the investor may want income later. A portfolio with low fees, broad exposure, dividend growth, and price appreciation can offer both growth and future income potential. That is the point. Do not chase yield blindly. Build a compounding engine. Now let us describe the compounding loop clearly. A weekly contribution buys shares. Those shares may pay dividends. Dividends are reinvested to buy more shares. The additional shares may pay more dividends. The companies inside the funds may grow earnings. Some may raise dividends. The share prices may appreciate over time. Future weekly contributions buy into a larger and more diversified base. Over time, the portfolio itself begins producing more growth than the weekly contributions alone. That is the loop. The investor's job is to keep feeding the loop. Do not interrupt it unnecessarily. Do not panic sell. Do not withdraw early for consumption. Do not chase high-fee products. Do not abandon the plan because the first few years look boring. The early years are not supposed to be exciting. They are supposed to establish the loop. Now, what if the market crashes? Weekly investing becomes even more valuable if the investor can continue. During a crash, the same $35 buys more shares. That feels uncomfortable because the account value may be falling. But from an accumulation perspective, lower prices can be helpful if the long-term thesis remains intact. This is why downturns are emotionally difficult but financially useful for long-term investors. The person who stops during downturns loses the advantage. The person who continues buys more ownership at lower prices. Then, if the market recovers, those lower-cost shares contribute to the rebound. This does not mean every decline is harmless. It means broad, diversified, long-term investing is designed to use volatility rather than fear it. But only if the investor keeps contributing. That is the discipline. Now, the paycheck comparison is important. A full-time job can provide income. Now, a portfolio provides potential income later. At first, the paycheck dominates everything. The portfolio is small. But if the portfolio grows, the income from it can eventually become meaningful. At $160,000, the projected dividends may be around $9,000 a year. That is like a monthly supplement. At $942,000, projected income around $98,000 a year becomes more than many jobs. That is the moment when capital begins replacing or supplementing labor in a major way. But that moment comes from years of not interrupting the process. The income is not created in year 30 alone. It is created by every weekly contribution before that. The boring deposits are what make the later income possible. This is why people who mock small investing do not understand compounding. They see the $35. They do not see the curve. Now, there is another important point. Inflation affects future income too. If $8,000 per month arrives 30 years from now, its purchasing power may not be the same as $8,000 today. So the investor must think in real terms. That does not destroy the strategy. It simply means that the portfolio should continue growing. Dividends should ideally continue increasing, and the investor may need to increase contributions over time as income rises. $35 a week is a starting habit, it is not a ceiling. If you can start with $35 a week and later increase to $50, then $75, then $100, the projection changes significantly. This is how real financial progress works. Start small, build the habit, increase the contribution as income rises. Let the portfolio compound. The first amount matters because it begins the system. The later increases matter because they accelerate it. Now, let us consider the investor's behavior as income rises. If wages grow but lifestyle absorbs every increase, the portfolio does not accelerate. If wages grow and the investor raises weekly contributions, the snowball grows faster. That is why wage growth by itself does not create wealth. Savings rate matters. A person earning $150,000 who invests nothing is not building ownership. A person earning $60,000 who consistently invests may be moving in the right direction. Income helps, but behavior decides whether income becomes capital. That is the principle. Now, I want to translate the strategy into steps. First, choose a platform and account type. If the money is for retirement, use the appropriate retirement accounts where possible. If it is general investing money, a taxable brokerage account may be used. Understand taxes, contribution limits, and withdrawal rules. Second, choose a diversified low-cost portfolio. The source gives an example using 5 Fidelity funds: FXROX, FSMDX, FIDLX, FGRX, FDGFX, equal weighted in the simplified example. Third, automate the weekly contribution, $35 per week, or whatever amount is sustainable. The automation is the behavior engine. Fourth, reinvest dividends. Do not take the income early. If the goal is long-term growth, let dividends buy more shares. Fifth, review periodically but do not overreact. You may rebalance if one fund grows far beyond its intended allocation. You may adjust contributions as income changes, but do not react emotionally to every headline. Sixth, increase contributions over time. If income rises, raise the weekly amount. The faster you increase contributions, the stronger the future base can become. Seventh, stay invested through volatility. This is where the real results are earned, not in the spreadsheet, in the behavior. Now, what can break the strategy? High interest debt can break it. If you are paying 20% on credit cards, investing $35 a week, while ignoring the debt may not be the best first move. High interest debt is negative compounding. It can overwhelm investment returns. A weak emergency fund can break it. If you invest every spare dollar and then need cash for a repair, medical bill, or job loss, you may sell investments at a bad time. Panic selling can break it. If you sell during downturns, you destroy the long-term compounding assumption. High fees can break it. If fees eat too much return, the projection weakens. Inconsistency can break it. If you invest only when motivated and stop when nervous, the system loses power. Lifestyle inflation can break it if you never increase contributions. Because every raise is spent, growth slows. The portfolio is not enough. The surrounding financial life must support it. This is why personal finance is a system. Investing is one part, debt management is another. Emergency savings is another, income growth is another, spending discipline is another, tax structure is another. A strong outcome usually comes from the system working together. Now, the deeper reason weekly investing matters is that it creates alignment with reality. Reality is uncertain. Markets are volatile, inflation fluctuates, wages grow unevenly, rates rise and fall, news changes. No one knows the perfect entry point. A weekly system accepts that uncertainty and acts anyway. It does not require prediction, it requires repetition. That is why it is powerful. The world rewards people who can act consistently despite uncertainty. That is true in markets, business, and life. Now, if you are watching your money disappear faster than it should, do not only focus on the pain, focus on the direction. Is every dollar going toward consumption and rising costs? Or is some part of your weekly income moving into ownership? That is the key difference. If every dollar is consumed, time remains your enemy. If some dollars are invested, time slowly becomes your partner. At first, the partnership is weak, then it grows. Then it can become powerful. That is what compounding does. Now let us bring the whole structure together. Inflation has made everyday life more expensive. Food prices rose dramatically from 2020 to 2025. Interest rates rose from near zero to around 4% in the source data, making debt more expensive. Wage growth around 3 to 4% has not fully restored the purchasing power households lost. Markets have crashed many times, but broad long-term trends have recovered and moved upward. Long-term market returns have historically been around 10 to 11%, including dividends, though future returns are not guaranteed. Weekly investing helps ordinary people participate without needing to time the market. Small amounts build a snowball. A $20 weekly habit can grow from $1,040 in contributions in year 1 to a meaningful base by year 5. A $35 weekly habit across the 5-fund Fidelity example can, under the source assumptions, grow over 30 years into around $942,000 and projected dividends around $98,000 a year. The 5 funds each play different roles. FREPSROX is the total market core, FSMDX adds mid-cap growth, FIDELX adds sustainability and modern growth exposure, FGGRIX adds growth and income balance, FDGFX adds dividend growth stability. The average yield in the equal-weighted example is about 2.19%. The average dividend growth rate is about 15.24%. The average annual price appreciation is about 8.98%. The power comes from contributions, reinvestment, dividend growth, appreciation, low fees, and time, but the system only works if the investor stays consistent. That is the main point. Most people do not need a complicated strategy to begin. They need a durable one. They need something they can repeat when the economy feels uncertain. They need something that does not depend on guessing the next crash. They need something that can grow quietly while life continues. That is what weekly investing can provide. Now, I want to end with the principle that matters most. Time is neutral. It does not care whether it helps you or hurts you. If your money only sits in a paycheck cycle while inflation and costs rise, time can hurt you. If your money moves into productive assets and compounds, time can help you. So the question is not whether time will pass. It will. The question is what you are doing with the dollars that pass through your hands while time moves. $35 a week can disappear into convenience, or it can become ownership. $5 a day can be spent and forgotten, or it can be invested and compounded. One path leaves you with memories of small purchases. The other path can build a portfolio that may eventually produce more income than a job. The difference is not intelligence, it is consistency. A small habit repeated for decades can become a force. That is the lesson. Do not despise the small beginning. Do not quit because the first years look slow. Do not wait until you feel rich to start investing. Start with what you can. Automate it, reinvest it, keep fees low. Stay diversified, let the snowball form, then let time do what time does, because the same time that works against your paycheck can work for your investments. If you put the system on your side,